So, and we kind of spoke to this a little bit last week in regards to the fixed versus the variable.
Yeah, we have an article on that.
Yeah. So, but we'll do a quick high level on it. So, right now, with fixed rates being as low as they are, um, you have an opportunity to get yourself a fixed rate with a fixed mortgage payment that will last you, for that time length. Let's assume we're talking about a 5-year fixed rate, like we talked about last week. We're seeing 5-year fixed rates as low as 2.99 in some cases,
Even lower.
even lower. And so if you can get a 5-year fixed rate today at 2.99% versus taking a variable with a discount on average today, probably prime less.
Prime's 105.
Yeah.
So you're looking at around 3. Oh, sorry, no,
No,
2.95.
2.95.
2.9 thereabouts.
Yeah. So, you need to weigh the pros and cons. So you could either take the fixed rate option with a fixed payment and understand where you're going to be moving forward. Understand, what your financial obligations are going to be over the course of the next potentially 5 years, or take the variable that will have that small fluctuation. Now, when rates are so close, does it really make sense to take the variable? In our advice, probably right now, not so likely.
Yeah, but it all depends on your situation. So if you have the ability to, and the income, of course, to withstand fluctuations in the market, then we would look at that because it does actually still provide us the variable with a lot more flexibility than the fix in terms of being able to get the mortgage, make any changes, and it still gives you the ability to change or flip over into a fixed should you decide you want to
Correct.
take out some risk out of your mortgage.
Now that is very, we're going to say that question is very much specific to the individual. I think the easiest way to answer that is it depends. It's starting to sound like our lawyers that we talked about.
Well, let's talk about the minimums.
Yeah.
In Canada, as a first-time home buyer, or even a purchaser, as long as you're purchasing your primary residence, you're able to put down as little as 5% of the value of the property, up to 500,000. Right? Any amount over 500,000 and up to $1 million, it's 10% of the difference. So, for example, if you're purchasing a property that's 550,000, then your down payment would be 30,000. So 25,000 of the first 500, which is 5%, and then 10% of the difference, which is another 5,000. So the total down payment would be 30 on a $550,000 purchase. If you're purchasing anything over $1 million, then the minimum down payment is going to be 20%. Reason for that is that a couple of years ago, about a year and a half, 2 years,
2 years,
maybe,
probably.
the government introduced new rules which limits limits the amount of coverage, insurance coverage, up to $1 million. So anything up to $1 million is insurable. You can put down the minimum. Anything above $1 million, $1 million purchase price, the minimum is 20%.
Well, the simple answer to that is yes, you do need to have formal credit or I would say, quote unquote, good credit in order to qualify for a traditional mortgage product with we'll say one of our A lenders, being, with one of the chartered banks, or with a broker channel lender that handles, good credit clients. But with that also being said, we do have alternative lending solutions that will give you, that will cater to the individual that might have, bruised credit, might have some missed payments on their credit bureaus, or have had, late payments or even bankruptcies that have been discharged. We still can cater to that, to those individuals and get them mortgages. But over and above that, for individuals that simply just don't have credit products, we have our private lending solutions. Raj?
Yeah. So we'll go into a little bit more detail about that in future live sessions. Actually, I think the one that we have planned next week, where our topic is going to focus specifically on private lending. So we'll go a little bit more in depth into purchasing with or using private funds. but there are tons of credits, there are tons of solutions that we offer that allows individuals to purchase properties who may not necessarily have the greatest of credit, that don't have credit. And in some cases, I can think of individuals that are new to Canada that may not necessarily have credit. We can use other alternative sources to find to support their credit worthiness as a borrower, so that they can actually still purchase a home without necessarily having that fully established credit in Canada. So again, depends.
On a serious note, so closing costs, your closing costs that you would incur when you're purchasing a new home are comprised of a few different things. One, you would have on a purchase, you would have your land transfer tax that you would be required to pay. If you're buying in the city of Toronto, then we know you have the land transfer tax as well as the city of Toronto land transfer tax. So essentially it's a double tax. So that same amount that you would pay, hypothetically speaking, if your land transfer tax was, let's say $14,000 for your Ontario land transfer tax, if you're buying in the city of Toronto, you'd be paying an additional $14,000, so now $28,000 in terms of land transfer tax. Over and above that, you would have your legal fees that you would need to pay. Legal fees do vary dependent on the lawyer that you are using, but you would have your legal fees plus disbursements that you would need to pay, as well as if you have an insured mortgage, so a high ratio insured mortgage, you would have your the HST portion of the PST portion, portion that you would of the high ratio insurance that you would need to pay as part of that closing fee as well.
Right. So typically, lenders like to see about 1.5% of the purchase price in addition to the down payment. So, for example, if you're putting down, if you're purchasing a property of $500,000, your down payment is you're putting down a minimum, which is 5%. That's $25,000 as a down payment. And in addition to that, the lenders like to see, typically about 1.5% of the purchase price on top of the down payment for your closing costs.
Yeah.
If you're a first-time home buyer, you automatically receive a rebate for the provincial land transfer tax and as well as the municipal land transfer taxes if you're purchasing in the city of Toronto. So that would actually serve to lower your closing costs. But in all cases, the legal fees, your moving expenses, you should definitely budget for, and then any incidentals. Sometimes your legal fees. The lawyers will prepare a statement of adjustment so that will even out the difference between what you're responsible for and what the seller is responsible for. So sometimes there might be a credit to the seller, it might be a credit to you. So all these different things, and that's why play a factor into your closing costs, and that's why we estimate. We also recommend that whatever your down payment or whatever you're planning on putting down, think of it as not 5%, but 6.5% or even 7% in some cases, just to make sure that you have enough budgeted for closing costs.
Yeah, and the other part that we should probably mention, if it is a purchase, you need to take into consideration the potential levies that the builder would also have attached into that contract. And each contract that you have, each agreement to purchase for a new home, those potential levies, will range. And I guess a good word of point there would be to, when you're getting into those types of contracts, try to cap those levies. So write it in a maximum of $5,000 or $10,000 into that agreement that will assist you be able to control those potential closing costs that you would incur.
Cool. Actually, I want to jog my memory about something. So if you're actually purchasing a condo, specifically new construction, something where you bought it from plan 2 years ago or 3 years ago, you're taking possession of it now. What a lot of people always forget is that you don't. The day that you take occupancy isn't necessarily your closing date.
Yeah.
So your occupancy date could precede your closing date by 2 or 3 months or more.
Yeah.
During that time, you're paying the equivalent of rent. Like you're still taking possession. You're moving into the condo, but you're not. You haven't. The condo hasn't registered, so you haven't. So you're not starting to pay a mortgage yet, but you're paying what essentially the builder's mortgage.
Builder's mortgage, yeah, that's what it is.
That you don't actually get credit for. So those are things that you should also budget for, and we can get into further detail about that when we talk specifically about condos. But that's something that you should bear in mind as it relates to your closing costs.
Yeah. Oh, I like this question. More so because it seems like, ever since, one of the major FIs came to market and they have this, oh, you can get, pre-qualified in 30 seconds. And I'm looking at this and I'm like, that is worth absolutely nothing. So let's tackle that one head on. So the difference between a pre-qualification and a pre-approval are that one, and actually you talked about this last week.
We actually had a video with Alex Bruce from First
First
National
National,
talking about the pre-approval and what that situation looked like.
So a pre-qualification essentially, we like to say the pre-qualification isn't really worth the paper that it's printed on. So what does that really mean? Essentially, pre-qualification does not take into consideration the individual borrower's full creditworthiness. Really, all it is a snapshot of how much do you make. They may or may not do a credit bureau pull depending on the institution if it's when they're doing the link in the back end. So really, it's just a snapshot of how much do you make compared to what you're trying to buy, and do these numbers really work based on our qualification matrix or our debt servicing ratios, and then it spits out a number. But that in itself is not good enough for you to go out there and make an offer to purchase, because there's so much more to it than just the numbers, right? Credit comes into play, the down payment comes into play, the ability to prove the down payment, of course, make sure it's been in your account for a period of at least the 90 days, and a bunch of other factors. So when we look at a mortgage pre-qualification, if you're going to take the time to try to figure out the numbers, it's better that you actually go and get yourself some mortgage pre-approval, because the mortgage pre-approval will actually look at all elements of your borrowing ability, your credit, and give you comfort in knowing that the number that is generated on that pre-approval will actually be something that you can take and start shopping, right? And you want to give it a little bit more on the pre-approval?
Yeah, well, given our background in real estate, I want to having pre-approval or having a buyer with knowing what they could potentially purchase is a fantastic thing. But some people, they get the false sense of security knowing thinking that they've been pre-approved and they can go shopping 100%, everything's done.
Well, they've been pre-qualified.
Well, even with a pre-approval.
Yeah.
Right. So we, generally speaking, we generally tend to look at a pre-approval as a, specifically as a rate hold for a particular period of time, and that gives you a rough idea of what you can qualify for. We had last week in our video with First National, we talked about having a fully underwritten pre-approval and what the difference is with how they do it versus how other lenders tend to do it by just doing an automated, by having an automated system just generate a random number, not necessarily a random number, but
generate a number.
But generate a number. The pre-approval serves the purpose of, especially the fully underwritten pre-approval serves the purpose of giving you a pretty fair, a pretty solid actually idea that what you're able to qualify to purchase, with the exception of the security.
Correct.
So you can actually, you have the confidence of knowing that, save and except for the property that you're purchasing, and that the lender still has to vet and qualify, you're pretty solid in terms of what you're able to buy, because it's been vetted, the income's been verified, the credit's been verified. All of these other factors have been put through the process, with the exception of the property. So that way, when you're meeting with your realtor and you've given them the pre-approval certificate, they know, as long as everything checks out with the property, that there's no
No hiccups to come.
There's no hiccups. You haven't bought a shack, or you haven't bought something that's in a poor state of repair. Then you're pretty solid in terms of what you can actually that you can purchase. And we generally tend to work with lenders like that who give us a good assurance that our borrower, when they do actually do the pre-approval, is solid, good to go. Not good to go in the sense that you're going to waive the financing condition,
Yeah.
because we always specify that you want to put that in 2 to 3 days minimum. But it gives us a solid foundation that we can work with, and that you can work with, and you're fully confident that everything has been put through the process and you're good to go. My understanding of the options for homes is that it's a way for individuals to purchase homes by having the builder provide assistance in terms of the down payment. So it's in the form of a second mortgage that's been issued by the developer that you don't necessarily have to pay back until you sell the property, right? Actually, very similar to the CMHC program that's been recently announced for first-time homebuyers.
Yeah, that's pending date
Yeah.
to come, right?
Yeah, that's. Let me just stay focused on the topic, because I can kind of rant or on a tangent. But basically, it's a great way for people who don't necessarily. Not necessarily have the down payment, but because they would have a portion of the down payment.
But don't have the full.
Right. The whole purpose of that was to overcome the challenge of the benchmark rate at the time.
Yeah.
So you'd be able to qualify for a loan for a mortgage up to 80% of the value of the property. The options would kick in for the difference, which is registered as mortgage, but you don't have to pay back. So it doesn't change your qualifying. It doesn't change the qualifying guidelines. And then in 3, 4, 5 years, or whenever it is that you want to sell or refinance, you can refinance out, and then the options get paid down. The money that was advanced to you the loan that was advanced to you initially, as for the option, would get paid back from the proceeds. So it was a great tool, and it has been a great tool for people to use leverage to get into property ownership without having necessarily to come up with a full 20%. Now, since the benchmark rate or the stress test came in, I'm not quite sure how effective that is as a method, because you're still going to end up having to qualify not at the contract rate, but at the
Well, I mean, not necessarily so, right? Because we do have the ability to qualify with non-bank lenders.
Right.
Right, so we can utilize our non-bank lenders, i.e. our credit unions, in order to help qualify an individual with the contract rate versus qualifying with the benchmark. So that would assist them to qualify for potentially more, not potentially, will qualify them for more money, and then they can utilize the options on the back end in order to essentially get them hopefully to where they want to be with the additional down payment that would come in to form the full value of the property.
Mm-hmm.
So that would be it definitely, it's a way to help get you into the property that you're looking to purchase, and if that needs to be, or if that is the only way to do it, as long as that contract that you're signing on with the builder is something that's been reviewed, obviously having that reviewed by your lawyer to ensure that it does suit your needs in all ways, shape, or form, and then from there, we would definitely set you up with the right mortgage product to fulfill that borrowing need. So,
Cool.
all right, good luck.